I'd like to thank everybody for joining me today. Today, I want to talk about, tax-free retirement. We see a lot of authors, with books on tax-free retirement. We see a lot of conversation about tax-free retirement. But part of today, I want to talk about why we need to focus on, looking at how to prepare for retirement and making sure that taxes are eliminated or at least minimized in the retirement conversation. If you start looking at, where the US debt is, and this is one, currently the US national debt is over 34.8 trillion dollars. And we know that that is growing considerably. I think that one of the things to look at is with that debt, we're approaching $1 trillion per year of interest on that debt. And we're just about to cross that threshold. So not only do we have the spending problem in the US, we also have the interest problem. And if you look at our gross domestic product, it's only 28.27 trillion. So if you start looking at the trends, the debt is exceeding what our production is going to be each year. If you look at that debt now and start asking the question, how's the US going to pay off this debt? How are they going to address that interest payment each year? Well, number one, the government could spend less. And ask yourself if you really think that's a realistic, solution to what they're doing. We haven't seen government spend less in a long, long time. The government could raise taxes. Now, we see this pressure to continue to raise the taxes. They say raise the taxes on the wealthy, but we also know that's on the middle class and the lower class as well. Taxes are going up, and new and innovative ways to disguise that tax are happening too. The third one is the government could artificially devalue the dollar. Now, this is something that we think would throw the world in a lot of turmoil. This is something we see in a lot of third world countries. They devalue the dollar, their currency versus the dollar. And is that a realistic option? So if you start looking at these, what is the most realistic option? And that is the raising the taxes. So ask yourself, if taxes are going to be the same or higher in the future, why do we keep putting money away into 401ks, IRAs, 403bs, pension plans, all of these qualified plans that defer the tax that we're going to pay? They defer it now at a lower rate. And when we're in retirement, we're going to pay a potentially higher tax rate or a higher marginal rate on a larger number. So, there again, I'm not saying don't put away into qualified plans for retirement, but ask yourself the question, is this the best way to plan for retirement? We hear so much and we get bombarded. Oh, my company has a 401k. I need to put money into it. The government gives us the opportunity to do traditional IRAs and other qualified plans. But do you ever stop to ask the question, is this the best thing for me? Not for somebody else, but for you and your planning, is it the right thing? And there again, ask the question, if you think taxes are going to be higher, am I better off deferring that tax hit into the future where we're going to have a potentially higher tax rate? One of the things I never see talked about, we talk about diversifying our portfolio, but do you ever hear people talking about diversifying your taxes? Well, if you look at, we have the first bucket of money here. These are things that are going to be taxed today. If you have a savings account, whatever interest is gained there, whether you need it or not, is going to be taxed. Your CDs, checking account, mutual funds, stock, bonds, all of these, business income and securities and investments, they're being taxed today. We don't have control over that. If those are the things that you're doing, and part of it is our employment, or whether you're self-employed or working for somebody else, that's getting taxed today. So think about how big that bucket is. Then you look at the next bucket, and that's not taxed today. We're deferring it and we're getting it taxed tomorrow. So your IRAs, pensions, and annuities, yes, we're not getting taxed now, or we're not getting taxed on the growth now, but When we access that, you're going to have that tax tomorrow. So if you think about it, you're in a partnership with the IRS. And think about your partner. Your partner doesn't care about your situation. When you need to access that money, do you get to go to the IRS and say, well, hold it. I've got, more needs. I need more money to come out. Can you please not tax it? Well, we know that's not reality. So if you think about that tax today and tax tomorrow, just know you've got a partner sitting on your shoulder that's taking maybe a third to half of that, growth, and they're going to take it and put it into their pocket. That's the tax that you're going to pay. So think about that. If you're deferring your tax, are you deferring more to the IRS and less to you? There's a third bucket, and I think this third bucket we don't talk about enough. And this is tax advantaged or tax-free income. We can put it in municipal bonds, Roth IRAs. Roth IRAs are an incredible tool because you pay the tax now. Whatever that grows to, when you access it, there's no tax. So when you're retiring, looking at your retirement income, that's tax-free income to use 100% how you need it. You don't have Uncle Sam sitting on your shoulder taking, a third to half of that and putting it in their pocket each year. The other one is life insurance with, cash value life insurance. Properly, we've got to make sure that these are designed properly, that they are designed to be, cash, tax-free when we access it, tax-free growth during the deferral periods. But life insurance, cash value life insurance is a great tool. And if you think about it, it's a Roth without the limitations. So tax advantage means, yes, we pay the tax now, but when we access it later on, it's tax-free. Here's something that's worth looking at. What impact do taxes have on your return? So let's just look at this 4% tax exempt yield. And I've got tax brackets there that are set to come back into effect 1/1/2026. So you're going to have potentially a 28.33 or 39.6% bracket. But if you have a 4% yield and you're in a 39% bracket, that's over a 6.5% return. If you've got an 8% tax exempt return, that's 13.25 in a 39.6% bracket. So you start looking at tax deferred income and tax exempt income do have a different meaning here. I want to defer it, but I want to be able to access this tax exempt. And if I can get a 6 or 7% tax exempt return, and I'm in a 33% bracket, that's a 9 to almost 10.5% return if I was looking in a taxable investment. So now I don't have to be as aggressive in my investments, and I can focus on the return of my money as much as the return on my money. So ask the question, if you were a farmer, would you rather pay tax on the seed or the harvest? Well, if you think the harvest is going to be more, why do we put so much into that future tax bill? Versus I could pay the tax on a little bit now to have a big tax advantage in the future. So if you start looking at this, there's different plans we can look at. And if you look through these, tax deferred growth, access to the money, all of this comes into looking at, properly designed cash value life insurance checks every box there. It allows us to access our money when we want, how we want. And also the other flip side of that, if you don't need the money, you're passing on a tax-free death benefit to your family. If you're looking at an IRA, a Roth IRA account, a Roth IRA, will also do a lot of things, but remember, it doesn't leverage that death benefit if something were to happen early. If you look at qualified plans, not a lot of check marks there. You get tax deferred growth, but remember, everything else is taxable, and you can't access the money till you're age 59 and a half. And if you don't need the money, your required minimum distributions will kick in. You can create an ancillary death benefit because some qualified plans allow us to use life insurance in them. Traditional IRAs, they're again tax deferred, but taxable in the future. Roth IRAs are a great tool, but we don't have the leverage. That's the big key that life insurance can bring in. So as you start looking at the question, do you want a tax-free retirement? The question will be, can you set it up? And it may, and there again, don't think all or nothing. Think about your client and your client's situation and what you can set up for them. So I appreciate everybody getting on. If you have questions, let me know. If not, we'll talk again next week. Thank you.